I think, first of all, it's really not uncommon to have these IPO stocks be volatile when they first come out. And I actually look at the Lyft model the other way, to be honest. I think there's probably more room for upside in that model than there is for downside. I think, as the company has talked about its prospect, I think it's been, pretty conservative, and I think that's reflected in our numbers. I'll give you a couple quick examples. One is that we only expect Lyft to add to get up to 33 million active riders by the year 2023. That's from 18 million today. At 33 million several years from now, that's a small number relative to 280 million smartphone users in the United States. And then the second thing is that when we look at rider engagement, we're really only looking for the average Lyft rider to go from 3.3 monthly rides per user up to about 4 monthly rides per user in 2023. And I think that's also conservative, because I don't know about you, but I don't know anybody who's not, pretty dramatically increasing their usage of these ride-sharing networks.
That's true, but to get from that 3.3 rides per month to 4, what needs to happen? I mean, does price need to come down? I know more and more people who, they take more, but they will toggle between Lyft and Uber and take whichever one is cheaper, because at the end of the day, this is a commodity service. It doesn't matter if it's Lyft or Uber or Juno or Via or any of the other ride shares that are out there.
One of the points, it's a good point, and one of the things that we outline in our note today is that in most markets in the United States, Lyft operates in mostly a duopoly. And what we've seen over time is that duopolies work pretty well, and even oligopolies with a couple of dominant players. We looked at AT&T versus Verizon and UPS versus FedEx. Several duopolies like that over time, and you really can have constructive markets when these companies start to kind of grow together. We think Lyft right now is has been gaining share in most of the major U.S. cities over the last couple of years. We'll see if that can continue, but one of our key takeaways is that the growth in the category really should be quite strong, and if there are market share fluctuations underneath that, we think Lyft will be okay relative to all that.
Does Lyft make money on every single ride? And I asked you that because of these other duopolies that you use as an example. I bet if you went to their early days, UPS and FedEx wouldn't have been delivering packages and subsidizing every single delivery to the consumer, training the consumer to want to deliver a package for below what it costs.
Well, there are a couple of inefficiencies in Lyft's model right now. One of the biggest ones here over the short term is what they're spending on insurance costs. We think the company's spending roughly 20 points of revenue on insurance right now. And we think that can get cut in half over time as the company gets more efficient at purchasing insurance and gets better at routing the vehicles into lower risk routes so that there are fewer accidents. As we look ahead to the longer term, one of the things that we think can happen that can really be a benefit to this industry is as we shift to electric vehicles and autonomous vehicles. Electric vehicles have fewer moving parts, in most cases cheaper fuel. That brings those costs down. And then when we get to self-driving, you obviously can start to substitute a machine for a human driver, and that can also bring costs down as well.